Now we have Mr. Ravi Saraogi. Can you switch on to the screen? Mr. Ravi Saraogi is a co-founder of the Samasthiti Advisors and a SEBI registered investment advisor. He's previously handled the fundraising and product design functions at Northern Arc Investments and has worked with the institutional equities research team at IIFL Capital and JP Morgan. Ravi was recognized among the 40 under 40 outstanding professionals in India's alternate investment industry by the Indian Association of Alternative Investment Funds. He is consulted with the social impact investments team at the UNDP also. Ravi holds a master's degree in economics from Madras University and a CFA charter holder from CFA Institute, USA. Now I am switching off from here and would request Ravi to please share the screen and start your presentation. Welcome, Ravi. And please have a round of applause for Mr. Ravi Saraogi, joining us online from Chennai. Ravi, you are on.
Okay, great.
Right.
I hope all of you can hear me now.
Yes, you are audible. Thank you.
Thank you. Thank you so much, Mr. Prodipto. Thank you, PFRDA, for this opportunity. It was really a pleasure listening to the prior presentations as well. Now, when we think about retirement, there are broadly two schools of thought. So one is what we can call as how the academia thinks about the problem of retirement. And in the academic studies, it has been demonstrated that when you try to convert a volatile pool of asset, like for example, part equity portfolio, into a predictable pension, the amount of assets that you will need is very large. And in that sense, when you try to use volatile assets, it's inefficient. And I think academic studies have shown that solutions which try to immunize the risk of inflation, either through problems of longevity, either through annuity or through other options, those work much better. The same problem of retirement and how to convert and how to generate a predictable stream of income, when practitioners think about it, it's very different. Practitioners engage with the retiree for whom they are building a retirement plan, and the solutions that they offer is very different, because they gravitate more towards what is a safe level of withdrawal to do. There are techniques of portfolio construction, and then the question is, okay, now what rate should we withdraw to make this corpus last? I have had the benefit of being exposed to both these schools of thought. I am an economist, so I have had exposure to the life cycle hypothesis, the use of, predictable products like annuity for generating a stream of income. So it was, very heartening to look at the presentation by, Mr. Arun as well as, Ms. Renu. But I am also a practitioner. As an advisor, we build retirement plans for clients, and I'm able to see the differences in both these approach. I think the key issue, from a practitioner point of view, is that when you try to communicate to a client why it's so important to take risk off the table in your retirement plan, the key pushback always is that where is the upside, right? So if you take a solution from what a financial economist would recommend, and even if you prove through math that this is indeed the most efficient solution, there is always a behavioral pushback in terms of this solution offers no upside, and which is also why many retirees gravitate towards the safe withdrawal approach. That's also the reason why there is such a large literature on trying to estimate what the safe withdrawal is, because that approach leaves the upside to the retiree, and of course there's a cost to that upside, that the retiree is indeed taking the portfolio risk. So on that context, I'll start my presentation. It's titled Designing a Predictable retirement income in the NPS. As a SEBI-registered intermediary, I'm obligated to just showcase this disclaimer. Nothing here is financial or investment advice. It's purely for educational purposes. When the consultation paper was released and when I had the opportunity to take a look at it, I was quite genuinely, surprised, because like my speakers earlier had also mentioned, retirement for long has always been so much about accumulation, very little about accumulation. There was this consultation paper which was very, very actively talking about how to decumulate. And I think, it's very, very timely, and it's great that we are having, this conversation. Most of my talk today will be based on a working paper that I put out earlier this month, and I'll be taking you through my evaluation of Pension Scheme 1 and Pension Scheme 2, the two withdrawal schemes that have been mentioned in the consultation paper. A very quick recap. I'm sure most of you are aware of these two withdrawal schemes, but just would like to take 2 minutes to just run through these two withdrawal schemes so that we are all on exactly the same page. So Pension Scheme 1. So yeah, I hope you can see my laser. So Pension Scheme 1, let's say, has a target pension of 50,000 per month. So these are numbers that I've taken from the consultation paper itself. There is a systematic withdrawal plan which the retiree does for 10 years and then annuitizes after that. The withdrawal rate, initial withdrawal rate is 4.5%, and it's increased by 0.25% per year. Here, I would just like to highlight that there is actually no inflation indexing in the first 10 years. We shouldn't misconstrue this increment as inflation indexing, because of course, yes, it is inflation indexing in the sense that the pensions will increase year on year, but it's not linked to the same increase as inflation. Actually, inflation could be higher or lower. But the fact that the retiree is able to increase their pensions for the first 10 years at least is that's a good feature. The equity allocation that the retiree keeps for the first 10 years is 35% equity, as mentioned in the consultation paper. The key risk behind Scheme 1 is what is the annuity pricing at age 70. So we don't know. And the key risk also is that post 70, because the retiree is annuitizing at a fixed rate, the purchasing power erosion, will be there. In Scheme 2, let's look at again a 50,000 per month, but in this case, it is inflation linked. The duration is 25 years and not 30 years, which is typically what we see in retirement studies. The withdrawal rate is 3.5%. Now, the consultation paper doesn't mention a withdrawal rate, but the consultation paper does mention a corpus amount. So you can very well back calculate what is the withdrawal rate which is embedded in Pension Scheme 2. So that's at 3.5%. We'll take a look at what this means. Equity allocation, again, 35% in Pool 2. So in Pension Scheme 2, Pool 1 is used to annuitize or, through a bond laddering or through a mix of risk-free instruments generate a fixed, payout. Pool 2 is what is used for inflation hedge. So there the equity allocation is 35%. The key risk is longevity beyond 85 years of age, and of course the market risk is entirely, the inflation hedge market risk is entirely on the retiree. So the question of corpus adequacy or inadequacy remains. Now, in terms of evaluating these strategies, I have used stochastic techniques, Monte Carlo simulation. I have used equity returns as approximated by Sensex, debt returns as approximated by 1 to 3 year fixed deposits rate as published by the RBI, and for inflation I have used the CPI industrial worker series. Now, a key methodological question when somebody tries to analyze these pension schemes through a simulation framework is what kind of simulation to do. One option, of course, is to have a distributional assumptions for each of these variables and sample from that distribution. That is an incredibly difficult thing to do, for a researcher, to model these asset classes and inflation with a high degree of certainty about, the distribution that will put on these data can be construed to be very, very suspect. So that's not what I have done. I have used bootstrapping. So I have picked out data historically and used that for simulation purposes. Now, even here, there is a big question. What is the data that you are going to feed into the simulator? So how many years back are you going to do? Now, when you look at Sensex data, it's available from 1980 onwards. So technically, you can go all the way back to 1980. Debt returns, of course, is also available. RBI publishes that series all the way back, even going up to 1960s. The inflation index, as maintained by the Ministry of Statistics, the CPI that we generally refer to, so that's of a more recent vintage. But the Labour Ministry maintains a CPI Industrial Worker Series, and that has a substantial amount of vintage. So we could very well roll back the clock a lot and feed that data into the simulator. But as we see here, if we look at these data series and break down these data series into different decades, we see that there has been a fundamental structural change in the Indian economy, pre-2000 and post-2000. So pre-2000, we were a high nominal return, high inflation economy. Post the year 2000, we seem to have moderate level of inflation and accordingly a moderate nominal returns, as well. This is seen in both equity returns and this is seen in both debt returns and inflation. So when you look at both these series, it's quite evident that the pre-2000 data is very different from the post-2000 data. So we have used the post-2000 data in the simulator. So the last 25 years of data is what is fed and what is actually bootstrapped for doing the simulation exercises. Now, let's look at pension scheme 1 based on this methodology. So as we discussed earlier, we start with a 50,000 per month pension and it's increased by 0.25%. So every year there is a step up in the monthly amount that the retiree can withdraw. And at 70, you have a continuous fixed stream of income which is not inflation indexed. If you are going to ask a retiree to withdraw at 4.5% in the first year, you can very well backtrack what is the corpus. So the corpus is 1.33 crores. And at age 70, whatever is the corpus remaining, you annuitize, that. Now the key question here is, there is certainty and predictability in the first 10 years. The subscriber or the retiree exactly knows what they are getting into for the first 10 years, but at age 70, what is an income stream that they will lock into we don't know. There is no way to predict that because it will depend on what is the size of the corpus at age 70, as well as it will depend on what is the annuity rate at age 70, and both are complete unpredictables. So to get a sense of what the story could look like for a retiree who chooses this pension scheme, we constructed multiple retirement paths. So while the consultation paper, of course, being a consultation paper meant to spark further research, talks about a deterministic constant 8% rate at which the corpus grows in the first 10 years. We have done statistical stochastic modeling, so you can see that in each simulation there is a different path, a different terminal value of the retirement corpus at age 70. So this is the distribution of the corpus that we have obtained. So a retiree starts with 1.33 crores at age 60, and at age 70, this is the distribution of the corpus after 10 years, and like I mentioned earlier, this is assumed with a 35% equity allocation. So if we see the 5th percentile, which is the really bad outcomes, the retiree is exposed to a very, very poor sequence of returns. The corpus stands at 1.5 crores. Basically, the corpus sort of stagnates. The median corpus is 2.5 crores, and the best case, the better outcome, 95th percentile outcome is 4 crores. Corresponding to these corpus and assuming that the retiree would like to maintain their withdrawals at age 70, we can actually back calculate what should be the required annuity rate so that the retiree can continue withdrawing at age 70 whatever they were withdrawing at age 69. This is an outcome of that. So we have reverse calculated. So for each simulation, we have reverse calculated what should be the prevailing annuity rate at age 70 so that the retiree can continue their withdrawals without taking any haircut. I think the story looks pretty benign and pretty good for a retiree who's into this scheme. The 5th percentile outcome. So this is a case where the corpus is very large and hence a very small annuity rate is actually sufficient for them to continue their withdrawals. The medium outcome will require an annuity rate of 4%, and the worst case outcome, the 95th percentile outcome, so these are really the outcomes where the corpus becomes really less. So even those will require an annuity rate of closer to 6%. Based on the current prevailing market annuity rates, this is very much within the pricing range. So for a retiree who's getting into pension scheme 1, they can have a reasonably high amount of certainty that they will be able to sustain their payments post 70 at the rate what they were withdrawing at age 69. Now, just as a thought exercise, we also looked at what if the retiree doesn't annuitize at age 70 but continues to self-withdraw the annuity amount on their own from their portfolio. In this case, what would be the corpus at age 90? So assuming a life expectancy of 90 years, what would be their terminal wealth, which is effectively inheritance assets for the retiree or buffer assets in case they actually live longer than age 90. So the median ending corpus is about 13 crore. The 95th percentile outcome is 33 crores. And there is less than 1% of the outcomes in which the corpus becomes negative. So there are actually outcomes in which when the retiree chooses to withdraw on their own, there are cases when they actually run out of money before the age of 90, but those are less than 1%. The reason why the outcome looks so good in this chart is of course because the retiree is not inflation indexing their withdrawals post the age of 70. So the corpus actually has to do very little heavy lifting, and which is why we see what we see on the screen. We did a sensitivity analysis. We tried varying the equity exposure between 20 and 80%. And instead of a 4.5% withdrawal at the start, we tried different withdrawal rates as well. And then we observed what should be the required annuity rate at age 70, as well as what is the failure probability in case they were to withdraw on their own after 70 years of age. So we did a sensitivity analysis for both of these. So I'll just briefly take you through this table. As the equity allocation increases, the required annuity rate goes up. This is actually an indication that as the equity allocation increases, and because we are looking at the 95th percentile required annuity rate, higher equity allocation leads to higher 95th percentile worst case outcomes. So the required annuity rate starts inching up. And as you increase the withdrawal rate, of course, as you increase the withdrawal rate, you also see that the required annuity rate, keeps, going up. So this is exactly what we would expect intuitively, and data, supports that. What is the failure rate in case the retiree continues to withdraw post the age of 70. So pretty much below 50% equity, and for withdrawal rates up to 4%, the withdrawal rate is negligible. Of course, as we increase the share of equity a lot, and as we move into much higher withdrawal rates, we see that the failure rate goes up non-linearly. But for vast majority of the cases where we are keeping moderate equity and we are keeping moderate withdrawal rates, there is no failure rate. And again, this is simply because post age 70, the retiree is not inflation indexing their withdrawals. So I think the key takeaway for me from this is that in the consultation paper, the equity is restricted to 35% and the withdrawal rate is set at 4.5%. And that appears, as far as the data is concerned, to be a very, very judicious, choice. Since we also have product manufacturers in the audience, it will be great to know for them how they look at this, and whether if there was a product to be built around pension scheme 1, the risk that the insurer would carry, does that appear to be benign or not? So it will be great to get a feedback from the product manufacturers, what they think about this. Coming to pension scheme 2. So in pension scheme 2, the starting pension is 50,000 per month, and then the corpus is split into 2 parts. So pool 1 is used to generate a fixed 50,000 monthly pension throughout their life using risk-free assets. So pool 1 could very well be an annuity, for example, where it gives you a 50,000 rupees per month income for the rest of your life. So pool 2 is an inflation adjustment component. So pool 2 is managed like an investment portfolio, and your inflation top-up over the 50,000 rupees is going to come from pool 2. The corpus that the consultation paper gives an example of is 1.72 crores. So if somebody is withdrawing 50,000 per month, so that's 6 lakhs a year on a base of 1.72 crores. So the embedded withdrawal rate is 3.5%. The chart here is simply showing us that because this is an inflation indexed withdrawal, so you can see the distribution of withdrawals at age 85 is substantially more than, of course, in pension scheme 1. And of course, there's a wide range based on the inflation that the retiree actually faces. Now, the initial withdrawal rate of 3.5%, what we see is actually a giveaway that this will turn out to be a sustainable strategy. And when I say sustainable, I'm talking about from the realms of safe withdrawal, studies. Of course, I'm sure practitioners and believers of the safety first school of thought who believe that no rate of withdrawal is safe because at the end of the day it's a risky asset base. I completely get your point. I'm just saying that from the vantage point of a safe withdrawal, literature research point of view, this appears to be on an a priori basis, this is a sustainable withdrawal rate, because as I show, there are studies, which show that this is actually a very reasonable level of withdrawals to do for a retiree, in India. Actually, which is displayed here. I have computed this in 2022-2025 using similar techniques. So for a 60-year retiree, was 60 and life expectancy of 90 and was going to spend 30 years in retirement, the safe withdrawal rate is in the range of 3 to 3.5% depending on your asset allocations and whether you have gold in that or not. So these have a 5% failure rate baked into it. So we know a priori that the story should look very good for pension scheme 2, but let's see what the data shows. Negligible failure rate, understandable, because while my earlier literature keeps a 5% failure rate, The number of years in retirement is 30 years. So here there is 5 years less of retirement. So the failure rate actually, compresses to even below 5%. And you can see that there is a good amount of terminal wealth left in most of the cases. In fact, from a regulator point of view, from a product manufacturer point of view, and from a practitioner point of view as well, I think more than anything else, it's not about the failure rate. I think this graph tells us something very, very important as to why people may not be going for annuities, why even when the literature proves to them that if they were to take a risk-free approach, a safety-first approach, that might work out better, why people still gravitate towards a safe withdrawal approach towards managing retirement corpus could be that there is significant upside on the table, for them, of course. In the bottom 5 percentile of the cases, there are challenges. But in the vast majority of the cases, when you fix a retiree at withdrawing at a very conservative, rate, the data does show there is a large leftover portfolio at the end. Now, I am intricately aware that one big flaw in this diagram is there is, we're talking about distribution of corpus at age 85, so where is the longevity risk aspect? I think the terminal wealth does take care of that in certain respects. And also that in all of these analysis, we are assuming a static withdrawal approach. So we are assuming that the retiree continues to withdraw an inflation-adjusted amount each year. But no retiree actually behaves that way. Even if you put a retiree on a very safe withdrawal path with a very moderate withdrawal rate, and they can very well inflation adjust their withdrawals each year, it's natural for a retiree to react to market movements and incorporate some amount of volatility in their withdrawals based on how their corpus is behaving. Right. And once you change assumptions from static withdrawals to dynamic withdrawals, the story starts looking even better. But that's for another day. We did a sensitivity analysis for pension scheme 2 as well. We varied the discount rates from 3 to 7%. So when in pension scheme 2, when we are breaking the corpus into pool 1 and pool 2, we need to understand what is the kind of discount rate to use for estimating the size of pool 1. So we just varied it from 3% to 7%. The pool 1 would be very low when the discount rate is 7%. So if somebody is getting a very good risk-free opportunity at 7%, they will require lesser of pool 1, and more of pool 2 is then available for inflation fighting. What we also did was we looked at different withdrawal rates from 2% to 5%, and what we observed was how does the failure rate, change based on that. But this is what the story looks like. So you can, as the pool 1 discount rate, goes up. So for any given withdrawal rate, as the pool 1 discount rate goes up, the failure rate comes down, which is exactly what we would expect, because a higher pool 1 discount rate leaves more assets in pool 2, and which is really needed for inflation fighting. The other thing that we observe is that the failure rate, increases for any given pool 1 discount rate. The failure rate increases. That is again, as expected. The withdrawal rate of 3.5%, is actually a very safe withdrawal rate, irrespective of what is the, pool 1 discount rate that the retiree is eventually able to lock into. So before I come to there again, and this question is more, really from a practitioner who has no window into how product manufacturers think about this. So I have no leg in that department. So this question is more, for the audience, that can product manufacturers look at constructing a product like this, where of course the annuity is already an available product. Pool 2, which is an inflation hedge, is managed as a portfolio. Of course, I don't think the insurer is going to take the risk of inflation hedging in Pool 2, but can that risk be retained by the retiree and a packaged product be created? So pension scheme 2 in a way is nothing but it's an annuity plus a balanced advantage mutual fund, very simply speaking. But those are still two disparate products. But if a wrapper is created which combines both of these products, which is an annuity and an investment product which is managed institutionally, I think that product will be a very, very attractive product, because right now what planners have to do is to reverse construct these products in their practice. So, a planner, for example, like myself, might recommend a certain level of annuity to a retiree, and that's for bringing in some amount of stability into their, retirement life, and then have a side-by-side managed portfolio to fight inflation, as well as to show retiree that, there could potentially be upside if that portfolio is managed well, and also, of course, in case markets do work, in their, favor. In fact, there is very strong literature of when you combine the safe withdrawal methodology with a safety-first approach, either through bond laddering or through annuity, the outcomes potentially look, quite good. So it'll be interesting to hear from the product manufacturers their view, on this. So this is pretty much the close of the presentation. I just would want to leave a thought that there is a wide range of dynamic and adaptive withdrawal strategies, and in these cases, the withdrawals is not only a function of a fixed withdrawal rate that the retiree has latched onto, but it's also a function of how their corpus is evolving, and the withdrawals are adaptive based on that. Of course, this introduces a level of volatility for the retiree, but in my research, which I had released earlier this year, there is promise into looking into this department. So this is simply, for example, there are approaches where by introducing a small amount of volatility in a payout to a retiree, the outcomes can be made a lot more safer. So in fact, the safe withdrawal approach starts coming little closer to the safety first approach if the retiree is willing to incorporate volatility into their withdrawals. Now, how realistic is volatility into their withdrawals? So unfortunately, for the US market, there is a significant amount of research which maps how retirees actually spend during their retirement. So there's a smile curve. As you retire, your real spending actually falls, and then the real spending picks up again towards the later half when the medical expenses could be higher. So there is, and of course there are studies which show that the real rate of spending actually shows a 1 to 2% decline each year. Unfortunately, in India, we do not have such studies which documents retirees' expenses, so we don't know what dynamic strategy is suitable for an Indian retiree, what is the kind of patterns that they exhibit in their retirement. But, this is an interesting space for policymakers to, look into. So, to summarize my thoughts and observations, so pension scheme 1, it brings a lot of, simplicity into the decumulation process, but there is an erosion of, purchasing power. And one aspect that I'm looking into, of course, in India, we don't have an inflation index pension, but I think LIC did come up with an annuity product which has a built-in increase of about 2 to 3% each year. Again, which is not inflation linked, but at least some amount of increase, in the annuity payment. So I'm trying to incorporate that and see whether in pension scheme one, how does the story look like if we allow some increase in annuity payouts post the age of 70. The pension scheme too, of course, this is your typical safe withdrawal methodology where, a portfolio is being managed and inflation, indexed withdrawals are being done. The limitations are, of course, longevity risk, the market risk, and of course, anybody steeped into the literature taken out by financial economists would, not look at such an approach very, very favorably, but continues to be extremely popular among, retirees. So for further research, combining safe withdrawals plus annuity, which is actually the construct of, pension, researchers like Professor, Moshe Milevsky, they have done a lot of work on this area, and we can try and see how to bring pension scheme to closer to existing literature. But of course, the million-dollar question for pension scheme too always is, will product manufacturers have appetite for this product? The DB world is, long gone. We are in a DC environment, and how feasible will a product manufacturer feel about generating inflation-indexed withdrawals? There is merit to evaluating a wide range of dynamic strategies. And lastly, very, very timely conversations about decumulation. It's fantastic, the consultation paper released by PFRDA, and exciting times ahead in terms of what are the decumulation strategies that subscribers might actually see in NPS in the near future. So thank you. Thank you for the opportunity. Love to hear your thoughts on this.
Thank you, Ravi sir. Now we'll be starting with the Q&A session for this presentation. We'll try our best to ensure that the questions reach you. So please, if anyone has any questions.
Hello. Mr. Ravi, I would like to give you a compliment about the research you did about pension, that is pension scheme 1 and pension 2, and you use sensitivity analysis also. So my question is that, so while designing the pension scheme 2, so did you take into consideration some like market factors, some other factors, So without considering some outlier or market factors or factors which are not within the control, so how would you expect that the return would be good or scheme? I mean, the failure rate is something less than 1%. Hello.
Sorry, I didn't get the full question. If you could please repeat it. Sorry, there's a bit of an audio issue. If maybe somebody could just come closer to the mic and repeat the question for me.
Yeah, you did a comparison between pension scheme 1 and pension scheme 2. So pension scheme 2, where the failure rate is less than 1%, and you are saying that the down the line the payout would be for 25 years. Okay? Hello? But while calculating the return, so did you consider some other factors which are normally considered by the economist while designing the model? See, I'm not aware whether you use the data of last 25 years, 30 years, or you just made a projections for next 25 years or 30 years on the basis of past data.
Ravi sir, hello.
So I think I get your question regarding how did I arrive at how did I arrive at a failure rate of less than 1% for pension scheme 1, pension scheme 2. What was the methodology? So I'll just pull out the methodology slide. So I have used bootstrapping. So let's say a retiree is 60 years old and retiring today. Now next month, their portfolio is going to face some equity returns, some debt returns, some inflation. So what I've done is I've gone back 25 years, picked out at random a particular month in the year 2000 to 2025. So that's 25 years of data. And for that particular month, the retiree's portfolio sees that equity return and debt return. Next month, so this has been done monthly, not yearly. So next month again, the simulator picks up any particular 1 month from the year 2000 to 2025 completely at random. And this way, the portfolio, so for every simulation, we have generated a path of how their corpus evolves. Now, certain things to note here. This is a completely random simulation. So in one particular instance, the simulator may be picking up, let's say, May 2005 data. And in May 2005, whatever was the equity return, debt return, inflation, it models based on that. Next month, it could be October 2012. Now, if we look at the asset return data, there is trending. So equity returns do exhibit momentum. Interest rates also exhibit momentum. And in fact, if you were to do a test on inflation, inflation also exhibits some momentum. So there is some amount of trend which is built, into. So you can very well do a correlated random sampling, where if the simulator has picked up, let's say, October 2005, the probability of the next month's return being closer to October 2005 is higher. So you can simulate based on that. However, that will reduce the amount of volatility that the simulator is generating. I wanted it to be more pristine, so I have completely disregarded trending. And so, if you were to incorporate trending, then the outcomes will look better than what I have, shown here. The other aspect that I wanted to highlight was when you do a test of co-integration in debt, equity, and inflation, all of these three time series, they are, correlated across time. So the equity return that is earned in one particular month has a relationship with the debt return that the retiree is going to earn, and that in turn, of course, has a relationship with the inflation that the retiree is facing. We of course know the relationship between interest rate and inflation. So there is a very strong co-integration between these three series. So what the simulator does is, if it has gone back in time and it has picked up, let's say, October 2005, it will use the same equity return, debt return, and inflation as it was in October 2005. So that way, while it is simulating and generating random paths, it is maintaining the co-integration in these three data series. I hope that answers your question.
Sir, now I understood that you use the data for 2000 to 2025. But suppose I have to replicate this model for next 25 years or 30 years. Because suppose today I ask somebody to join this scheme and he is going to put the money for next 25 years. So will you replicate, is it going to replicate that, he will be the best if we go for pension scheme number 2 rather than 1? Because, down the line, 25 years, there will be a lot of changes. So for that, some kind of discounting pattern or, plus minus, in terms of equity returns, debt returns, inflation series also, that we have to take into consideration, plus some other factors also. Then in that case, how your scheme 2 will work in favor of pensioner or, normal public?
Okay, thank you for that question. So I think if I were to answer that as a practitioner, as a retirement planner, I think the planner's job is not really to push the retiree into one particular, product, whether it be pension scheme 1, pension scheme 2. I think it's about showing what is the range of outcomes that the retiree will see under both of these schemes, that is where the distribution becomes very, very important. A retiree can, for example, see the range of outcomes that, they will experience under both of, these schemes, and the exact product that they will go into will depend on their personal risk appetite and return preferences. So a retiree, for example, who is very paranoid about inflation adjusting their, withdrawals, will of course find pension scheme 1 extremely unsuitable, and they may gravitate more towards pension scheme 2. And even within pension scheme 2, what is the proportion of pool 1 and pool 2? That is so much dependent on the individual circumstances of the retiree. To give you an instance, if a retiree has, let's say, one property from which they are getting a rental income, they may construe that income as sort of being like an annuity. And they may want a correspondingly lesser pool 1 size because they don't feel the need for annuity, because they construe their rental income to be sort of like a quasi annuity, and that too with at least what typically rentals increase at the rate of inflation, so they may actually construe that to be an inflation indexed annuity. So they may be they may look for a very less pool 1. Accordingly, the practitioner can plan for a larger pool 2, but at the same time, for a risk averse retiree, pool 1 could be a very large component in their pension scheme 2. There are also aspects about what is the kind of assets that the client is bringing onto the table. In many cases, when we most Indians, for example, spend frugally. Most of them, by the time they have retired, have at least acquired their own house, so they're living in their own house, and their pension requirements are actually not substantial. They can do with a smaller amount of pension, and in those cases, those aspects could make pension scheme 1 for example more suitable. So we don't I don't think there is a clear-cut answer which is better. I think it's about offering retirees a range of choices to choose from.
Yeah, hi. I just to extend the previous question further, you have taken data from 2000 to 2025. If you do a similar exercise with maybe data from 1st April 1995 to 31st March 2020, there would be a difference because those were the periods when markets actually on March 2020, at least equity was on bottom of the corona and all those things. So will this simulation change a lot, or do you think it will remain at similar levels?
Yeah. Okay. Thank you for that question. So if you extend the timeline pre-2000, and as you keep extending it, the story keeps getting better. The reason is that you can see a little bit from here.
No, it's 95 to 2020. So you take 20-year period, 25-year period starting 95 to 2020. I'm not saying.
So you're saying we take the period from 1995 to 2020.
Yeah.
Sorry, is that the question, from 1995 to 2025?
Right. 1995 to 2020.
Okay, 1995 to okay, yeah. So let me answer that question in more generic terms. We don't see much change in output when you change the window. In fact, when you look at 2000 to 2025, 2000 is the start of the volatility relating to the dot-com crash. Then there was a bull market from 2003 to 2007. Then there was the global financial crisis. Then 2012-13 there was the taper tantrums. And then of course we had bit of asset quality banks related sluggishness around 2016, 17, 18. And then you had the corona crash, which also gets modeled into here. So the data from 2000 to 2025 actually really stresses out the simulation, because there is enough going on here to generate adequate retirement parts And when you take something different, let's say 1995 to the year 2020, generally you see better outcomes. I have not personally tried 1995 to 2020, but my sense is the outcome will look better, because what I have at least noticed is that as you keep going back in time, the story looks better. And I understand the point that as you keep going back, the nominal returns look good, but there was significant volatility. And of course, that nominal returns need to be looked at in context of the higher inflation. But unfortunately, I don't have a chart here, but I have looked at how real returns. So let's say if a retiree is keeping a 50-50 balanced portfolio between equity and debt, and you track the performance of that balanced portfolio, in real return terms from 1980 onwards till 2025, it shows a linear decline. So while nominal asset returns have come down because inflation has come down, but they have come down more than disproportionately compared to the inflation. So real return has actually seen a compression. Now, that's what the data shows. So in fact, if you take the year 2000 to 2025, you can pretty much be sure you are not sugarcoating things.
Now, let us assume for the sake of argument that NPS is all the money he has at time of retirement. Unlikely, but let us assume, because we are discussing NPS here. At the age of 60, let us assume also the person is not working, which is why the person is going for a pension. There is no comeback for this person in case something goes wrong, okay, because he's supposed to have retired, he or she is supposed to have retired. 35% in equity for a period of just 10 years. How much risky is that? It's just 10 years, huh? Something going wrong towards the end and it's not tapering it off. Suppose 7th year something goes wrong, 4th year something goes wrong. And 35% of his entire retirement corpus is a very large sum.
Yeah, I think that's really an excellent point. If we see I think a part of that, you see such a large variation in this distribution. So the 5th percentile is 1.5 crore, the 95th percentile is 4 crore. So there is sort of like a 3 to 4x difference between what the retiree may eventually see. And I think, there is merit in trying to evaluate that if someone was to opt for pension scheme 1, and given that their investment portfolio is going to be managed for just 10 years, how can we better protect their capital? I think maybe it may make sense to start off with an equity allocation, whatever is suitable, maybe 35%, 40%, 30%, but then taper off that equity exposure as they come to age 70, to better protect the corpus. In fact, that's something that, I can, my paper is anyway a working paper. The idea was to get feedback, from a large part of the stakeholders, and I could very much check for that and see how I'm sure once we do that, the variation in these distribution will come down, and I think the retiree will then have a better, grip on their portfolio at the end of age 70.
See, actually, it's a double-edged sword. If you are not in equity, if you don't protect the kind of returns, you will not have that kind of. It's a bit of a double-edged sword, because if you are not giving that kind of a high, if you're not projecting that kind of a high equity return with 35%, you will not have that kind of a corpus. On the other hand, if you taper it down, okay, you're not able to hear.
I'm able to hear now.
Okay. So actually, I don't have an answer to this. I'm just voicing it. Where the product that is provided for is the balanced life cover, which will have 35% in equity. Now the point is 35% in equity for a 10-year period only. If something goes wrong, we'll have a very sharp negative result in performance and give a negative result. That is number one. But on the other hand, and that's something I'm raising a question, I don't have an answer to this right now. If you taper off the equity, you will ultimately have a safer portfolio but a lesser quantum. So it's a double-edged sword either way. So I don't know if the answer is so simple or there is any answer to this. But I think it's a real-life issue.
Yeah, no, noted. I think that is a sword which cuts both ways. And I think some kind of balancing act has to be done. And I totally get your point. If you taper off, then you make the portfolio's expected return come down.
Ravi, this is Arun. And just to answer Subhashish's question, I don't think you can have a fixed allocation or a time-based allocation to equities. It has to be what I would call funded status based. And, I'll share a paper with the group if it's interesting, because that's the only way you can manage that risk of the downside. But I have a different question for you. Given that you've simulated these 10,000 parts and you have what would be the outcome in pension scheme 1 and 2 under all those 10,000 parts, are you able to then say what would be the average real retirement income, let's say from 60 to 80 or whatever, 85, under all those 10,000 scenarios, so that the ultimate goal I'm getting at is if you can provide a three-dimensional matrix, which is stocks doing well, stocks doing poorly, bonds doing well, bonds doing poorly, inflation high, inflation low, and in that matrix, this, determine whether pension scheme 1 outperforms 2, that may be more helpful to the product providers to be able to educate their clients. I hope that makes sense.
Yeah, thank you very much, sir. For that comment. In fact, on a separate note, before I answer that question, in 2022 is when, as a practitioner, I was first introduced to Bengen study. It was very late. Of course, 30 years had elapsed between 1994 Bengen study and the safe withdrawal approach looked like as a very suitable approach, at least compared to the previous approach where you were just projecting equity returns, debt returns, and not accounting for any volatility and using simple present value, future value formula for trying to tell a retiree what is your suitable corpus and how much you can withdraw. So the safe withdrawal approach was substantially more advanced than that because it accounted for sequence risk. And then, once as a practitioner, I gravitated towards that. That is when I came across a paper. One of the co-authors was, William Sharp. A 4% withdrawal, but at what cost? And when I read that paper, I felt like I have come back to zero again, because here was a financial economist, no less than William Sharp himself, was showing how inefficient the safe withdrawal methodology is. And in fact, I really enjoyed your presentation, and I've made a note of the references because, I stumbled upon all of this research which showed that, why keeping a very large corpus and then trying to generate a stable income out of it when that corpus itself is volatile, at least from a financial economist theory point of view, appears to be, not a particularly smart thing to do. But my, concern as a practitioner really has been that the solutions which a financial economist, puts on the table, there is so much of pushback, from a practitioner, from a point of view. Now, so I would love to see how to sort of marry, both these worlds. But coming to your question, in these 10,000 simulations, the withdrawal, the inflation index withdrawal remains constant. So in each of those simulations, what is not changing is the withdrawal. So of course, the withdrawals is changing in the sense that the inflation, changes, but in each of those simulations, the retiree is withdrawing an inflation indexed amount. And we're trying to see, given the equity and the debt return, whether the corpus touches the 90-year mark, 90, age for the retiree. We can drill down and look more into how equity returns, debt returns are, affecting that. Now, one very, very clear thing that comes out is that equity, is the moment. So when you have a portfolio which is 100% fixed income, and as you keep increasing the share of equities to say 10%, 20%, and even going up to 30%, the outcomes look better, but the outcome becomes worse. Moment we cross equity exposure beyond 35 to 40%, the safe withdrawal rates actually come down. So equity at that, if we infuse more equity in the portfolio, it becomes, counterproductive. So this was at least very counterintuitive to me, because, and it's still a very counterintuitive thing to explain to a retiree. At least a typical retiree who's used to investing in mutual funds and stocks, they just can't wrap around their head that how can a 35% equity portfolio do better, as a retirement portfolio than a 60% equity portfolio. But fortunately, there is such a wide body of research. Every single researcher who has worked on safe withdrawals, they notice this exact same trend, and and that's because the safe withdrawals is a tail concept. So when you increase the share of equity, the median outcomes start looking better. So the terminal wealth keeps getting better, and tremendous amount of inheritance assets are created. But the safe withdrawal approach doesn't care about the median number. It's talking about only the worst 5% of the cases. And in that respect, as you keep increasing the share of equity, your worst 5% of the cases keep getting worse and worse. So there is a level at which you have to completely taper off the equity. Personally, in the portfolios that we design, we don't use more than 30 to 40% equity. I don't know if that answers your question, but I can also explore the three-dimensional matrix and see how does the story look like.
Ravi sir, I have a question. Am I audible? Hello?
Yes, I can hear.
Yeah. So, sir, to simulate the debt portfolio returns, we have used FD rates for 1 and 3 year, if I'm not wrong. Can we go to that slide? 1 to 3 year fixed deposit rates. So the volatility in the rates and subsequently the performance of a mark-to-market corporate bond or a gilt fund may vary drastically. So would the exercise have extremely different results if this exercise were to be done using probably the NAV on a corporate bond fund with a similar duration as to what our funds are, pension funds are, managing it with, and a gilt fund which has a similar duration, portfolio duration, which is in line with our investment objective. Sir, what's your thought on that?
So thanks for that question. So, I don't have the data for that. I haven't tried. I tried looking at a very old mutual fund. I think one of the oldest debt mutual fund or income mutual fund is Aditya Birla. Income mutual fund. The NAV I think goes back all the way up to 1995 or 1996, if I am not mistaken. So we can, very well use. Rather than fixed deposits, we can use, debt mutual fund. And even within debt mutual fund, you can use gilt funds. And even if we don't have the data for, NAVs of those, we can always use CRISIL, bond indices. However, my sense is, this is something I have, just mental made a note of. I can try that. My sense is that there is not much term premium to be really harvested in the Indian bond market. A retiree, I don't see why a retiree should take duration risk. If we look at the performance of dynamic bond funds versus, let's say, an ultra short-term bond fund in India, there is very little reason to select a dynamic bond fund. And of course, when I'm saying all of this, this could be my personal biases as a planner coming to the picture, but I think it's the reason why I took 1 to 3 year fixed deposits is I think a retiree should completely refrain from trying to play the interest rate curve. They should stick at the short end and focus more on an accrual yield, and which is why we use this. In fact, of course, when a retiree is subscribing to an NPS product, fortunately, they are not tracking NAVs on a daily basis. And of course, now we have a consultation paper from PFRDA as to why even that volatility can be taken care of by using HTM accounting. But when it's a mutual fund with a daily NAV, and somehow there is a culture among investors of tracking NAVs, they will simply not be able to relate to seeing a negative return on their debt funds. That's not something you can try explaining duration risk as much as you want, but you start questioning whether the client might put a complaint to SEBI regarding why am I seeing so that's a fiduciary problem that a planner like me has. We would never put money into a duration risk portfolio for a retiree, because as far as an Indian retiree is concerned, equity, you can lose money, you can they're prepared for anything, but they cannot handle seeing a debt return, a negative debt XIRR. So this is more suitable, but I can check. But I have a feeling that the leg up that we will get from additional maybe 50-100 basis points when we go up the term premium. But given the volatility that will introduce, I think the story may look either the same or slightly worse off. But I would love to check that in and incorporate it in the working paper.
Hi Ravi, can you hear me? Hi Ravi.
Yes, I can hear you.
Pushpinder this side from PFRDA.
Hi Pushpinder.
Hi. So basic question on the methodological side. So when I see Monte Carlo, I think about distribution. So you have cleared that you have used bootstrap methodology. One point is that you have discussed that you have checked the co-integration. So that has already been taken care with when you are taking year-wise data. When you are taking the random samples year-wise, you are already taking care of the equity, debt and inflation, the co-integration. But the second point is the time dependence of the single variable. So if I consider equity return as a unique variable, so have you checked the stationarity of the data? One point is that because there is a lot of debate in the literature whether we should take the simple bootstrap random sampling or we should take the cyclicity. And second point I have is it's about the expenses. So you are taking the data on equity and debt, which is not taking care of any expenses. When we are going through NPS, there is expenses, there is investment management fees, there are other CRA and other charges, which are owned by the subscribers. So there is one paper in literature by Gordon Pye, Journal of Financial Planning, 2000, which says that 1% expense ratio will decrease the safe withdrawal rate by 0.25%. So I have checked, I've done the similar exercise. Your rate is 3.5% if we take the 30 years horizon. When I checked using the NPS data, it comes around 3.3. So there is a dip of 0.2% because of the charges that are being borne by the subscriber. So these are my 2 points, if you can clarify. Thanks.
Thank you so much for that question. Yes, those are methodological gaps. I have not taken into account any transaction expenses. Of course, no retiree can exactly earn basis and sex return. They will have to go through a product, and of course NPS is the least cost product, but if they were to actually construct a mutual fund portfolio, that charges will be substantially higher. And I have not taken into account tax as well. So point noted regarding these two, that yes, these will impact the safe withdrawal rates, and the withdrawal rates will be lower once we factor that. Regarding the bootstrapping, yeah, so right now it's a complete random bootstrapping, and we can if we look at the stationarity, none of these data is stationary. In fact, the stationarity is better post the year 2000. Pre-2000, it's worse. The data is not only exhibiting a trend, but even there is volatility clustering, and any test of stationarity will fail. So post 2000, the data looks better, but that could simply be a function of at what stage we are in an economy right now, or for the past 20-25 years. As we develop more, that nature can change. So it's always a methodological question whether the last 25 years is the right set of data to feed into creating an outlook for how the next 25-30 years of data, but regarding it can be done. So one approach is we can use correlated random numbers to try and see. But the reason why I just run with this is that this is not my sense is the outcomes will look better, because when I across these simulations, when I do random simulations, when I look at the volatility of those parts generated, that's significantly higher. But the moment you introduce some amount of cyclicity, momentum, trending, the volatility actually comes down. So the output, my senses will look better. But I can add an annexure and look at how these numbers look like if we were to incorporate cyclicity.
Any more questions?
Ravi, I think we are finished up with the questions right here, and thanks a lot. Yeah, thanks for joining online and giving such a nice question and answering all the questions that we had. Now moving on. We are now at the end of this seminar that we had conducted right here. So from the audience that we are expecting, that we already have your email IDs, and the presentations that we gave today, the discussions that we had, they will be shared with you, along with the recording of this entire thing will be uploaded on YouTube, and we'll provide you the link. We expect that all the people, at least the participants, the annuity service providers, the pension funds, they should come out with their feedback on this consultation paper. The email IDs are already with you, my email ID and market.watch@pfrda.org.in. You can send across your measured feedbacks on the same.